to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and I've got Rob here from Accure Asset Management. Now, one of the big things about what we do here in the commercial property space is about showing the opportunities in the market, and that there's multiple ways to invest in the commercial property space. For some of you, you want to go and invest on your own, and that may be anything from a $500 million or $5 million property. But for some of you, you might be really, really busy. You might want to diversify. You might have money sitting in self-managed super fund, or you might have had an inheritance and you're just really too busy to look at investing on your own. And sometimes you want access to the higher level properties, so the stuff that are the 10 mil, the 20 mil properties, probably potentially with some uplift that you just can't access on your own. So the other option to do this is obviously through syndication. So there's multiple ways you can choose. A couple of your friends or family come together and do a deal, or you can join a group, or alternatively, you can choose to go with an asset manager, go into a fund and go through that way. So there's multiple options. It's about showing you the options. So that's why I've got Rob here today to talk about the different options. So, hi, Rob.
Hi, Helen. How are you? And thank you for having us on today.
Great. So tell us firstly a little bit about your company. Sure. What is it that you guys actually do? And just what is the rationale behind bringing the fund together or creating it?
Yeah, thanks. Look, Accure Asset Management is a wholesale property syndicator. So we raise money from wholesale investors, and we invest that money. We establish commercial property syndicates. There's a large spectrum of property that you can invest in, and we tend to focus on income yielding commercial property. So commercial property that's got a tenant that pays rent, and we then deliver a regular stable income yield to the investors. It's all about typically the structure with a property syndicate is pretty typical for the industry. It's setting up a unit trust that we then raise money, and each investor gets units in a unit trust. And really what we see is the benefit of having a syndicate like Accure is that you get access to professional management. It is an active asset class, and when things do go wrong, and they invariably go wrong from time to time, you've got a professional manager that can deal with the problems and rectify the situation and deliver growth and deliver investment returns to the investor.
So just to clarify, you talked about it's a wholesale fund. Just explain that a little bit. What does that mean?
Sure. So look, you've got with Asic, you've got two different types of investors. You've got your retail investors and you've got your wholesale investors. Retail investors are typically what they refer to as your mum and dad type investors that require a different set of disclosure when raising money. So you've got a prospectus or a product disclosure statement, PDS. With what we focus on is wholesale investors. They are sophisticated investors. They tend to have experience and they tend to have the wealth and knowledge required to assess these investment opportunities that we provide. And look, there is a reduced level of disclosure. An information memorandum is prepared, not a prospectus or PDS, but an information memorandum. It tends to summarise more the information required and has less disclosure, but we offer any investor that would like to access more information when assessing and making their investment decision, we give them access to the full due diligence of our reports, which is valuation and consultant reports. But typically to become a wholesale investor, you require an accountant certificate that certifies you as a wholesale investor.
Is there a minimum amount of money that they need to invest into a project or a deal you're doing?
Yeah, look, we typically our minimum investment size is $100,000, and it differs from syndicator to syndicator and trust to trust. But we think that's an amount that's achievable, and of course, they can increase and go more than that as well.
Yeah. Okay. So show us some examples of. I know that you've got some examples of what you guys have previously done, because and maybe some assets that how you could troubleshoot them and what's happened in the past. Yeah.
So perhaps I'll just say that Accure started in 2012. We've established 17 syndicates to date in the commercial property sector across all sectors. We've got office assets, we've got industrial assets, we've got shopping centres, we've got hospitality assets, and we've got fuel truck stops as well. What I'll do now is just share with you a couple of examples of some case studies of what we've achieved and how we've achieved it. Let me just bear with me for 2 seconds.
We can definitely share screen. I mean, one of the options is, there's that diversification. One of the big things that people miss in commercial property or any kind of property is that they don't diversify enough. And then, because I think we've learned through the pandemic that you really got to diversify. Or people who have invested everything into Melbourne sort of got hit hard, whereas people who've sort of left Melbourne and invested in different areas. But a lot of states came through differently. Brisbane really sort of went ahead, and Gold Coast sort of had a real surge. But we saw the ACT became really stable because they didn't have anybody with job losses with all government type tenants. So and every state behaves differently.
Yeah, that's a really good point, Helen. And that's really where syndicators come into their own. They provide investors with the access to larger properties nationwide that they perhaps couldn't do individually themselves. A great example is, you've got $250,000 to invest, and you could buy, a commercial property, maybe $500,000 to $1 million. Whereas if you invested that into a syndicate, you could get access to, you could get a 2% interest in a $20 million commercial asset. And when you get bigger assets, you tend to get better tenants and de-risked as well. Let me share with you just
of course.
All right, so this is some case studies I've just put together.
Yep.
This first one was it's a large format retail property in Western Australia. It started its life as a master's home improvement centre. We did a deal with Woolworths to develop and own a master's home improvement centre. As a lot of people would know, Woolworths reversed their decision to go into this sector, and after 2 years after purchasing the property, Woolworths told us that they're discontinuing their master's business. So in that instance, what we did, we immediately contacted Bunnings. It was a great site, and we renegotiated a new lease with Bunnings. They took on the asset. Our investors didn't miss a beat. They got their distribution yield continuing to be paid. We bought that asset for, $29.5 million, sold it for $49.5 million, and we sold it to another large REIT, Charter Hall. We bought it. We bought it well, and we sold it on a 4.5% cap rate. As a wholesale syndicate, we tend to focus on properties that deliver value, and we end up buying sort of in the 8 to 9% passing yield, and we're certainly sellers in the 4 to 5%. That particular property delivered an 8% average distribution yield to investors, got a capital gain of 84% on their individual unit price, and delivered a 17.6% IRR to investors over the investment term, which was about 6 years.
So so during that time, you guys actively managed, and everyone got an 8% return on their cash, right? So that's where the 8%, when you talk about it, that's 8%. And then when it was sold, they got a portion of, they got a portion of the sale, the capital growth of that.
That's correct. So in this example, they invested at $1, and they would have got $1.84 back in capital, and as well as 8% on their dollar for the 6 years, and that was paid on a regular monthly basis. The next example was an industrial property, again in WA. This was a 2.5 hectare site in metropolitan Perth. We had a mining services tenant. What we did here, we bought the property with a 1 year left on its lease, and then we negotiated an extension to that lease for 15 years, which delivered significant value. This particular property we purchased for 8.6% on a 10% yield. We ended up selling it last year for 16 million, and that achieved a 86% growth in the value of the property. And over that term, we delivered a 13% income yield to investors on their investment. We delivered a $2.08 on the $1 unit price, 108% uplift, and an 18.3% income IRR on their investment. And it just shows that, with commercial property, having that safe income yielding asset can still deliver significant returns. And a lot of that is delivered through, we were lucky enough to have a lower interest rate environment, which reduced cap rates. We had cap rate compression, but we also had a fantastic tenant that was very successful in the mining and services industry, and a long-term lease. I'll just go on to sorry.
Yeah, just with something like the one you said, it was 8.6 mil, sort of a 10%. With that, this is a single, so that the fund only owns that one asset. So in that actual correct. Setup. Okay.
Yeah, that is correct. Yep.
And when they, so when you're raising that, you go, well, there's a chance. What kind of criteria do you look for when you're looking at deals like this? I mean, this one has typically a 1 year lease. Is this just identified? A lot of people, well, how do they know that, you're buying at a really high yield, but how do they know that it's going to extend, right? What is the backup plan? What was, what are some of the considerations that chose this one over something else? I mean, these are the things that our viewers are going to be thinking about in their head when they're looking at this case study.
Yeah, look, it's a good question. And Accure tends to, as I said before, it focuses on value first. It doesn't matter what sector, we're sector agnostic. We look for value. And this particular example, we saw industrial property, which we like industrial. We thought typically we buy off market, so we negotiate directly with the vendor, sometimes through an agent, but it's off market, which tends to deliver better outcomes for wholesale investors. This particular one, we could see that whilst there was only a 1 year term left on the lease, it was a tenant that had been there a long time, and we were buying it at a value that we felt represented good value from a dollar per, capital value, a dollar per square metre basis, and that even if that tenant walked, we could find another tenant and at good value that would deliver good income returns. But we felt comfortable that we had a tenant that was going to stay. We engaged with that tenant directly, and we were comfortable that it was going to extend its lease. And, when you're looking for those opportunities that are off market and of high value, you tend to look at the vendor. What are they selling? Who are they? Why are they selling? And that sometimes plays largely into the considerations of getting a good deal. Let me point you just to another example. This was another industrial asset, again in WA. It was in a heavy industrial area, a 9 hectare site on a strategic coastal industrial precinct south of Perth. Now, this tenant was a supplier of water infrastructure to the state government. It had been there again a long time, and it happened to be that this site was just in the ocean. Right in front of this site was identified by the state government for a new container port. It was considering relocating the container port from Fremantle down to an offshore site in Coogee. So we negotiated. We held this property for about 8 years. We bought it for $21.5 million. We negotiated with the government, given it was strategically positioned and right in front of the outer harbour that was being proposed by the government. We ended up negotiating with the government rather than going to a compulsory acquisition. So bought it for $21.5 million, sold it for $40 million. That was an 86% uplift in value. We delivered an 11% regular income yield to investors, as well as 107% uplift on their investment, and which delivered an 18.6% IRR to investors. Again, a good outcome for really an asset.
What projects have you guys got on at the moment?
Well, look, we tend to look at value. During COVID, we were looking at office assets. There's a lot of uncertainty during COVID about the future of office. We knew that Melbourne and Sydney were going to be the hardest hit in terms of office assets and valuations. So we focused on multi-tenanted offices in cities that weren't necessarily restricted by public transport, getting their workforce in and out. So we looked at Adelaide and we looked at Queensland, and we ended up buying a office asset in Adelaide for $18 million, and within 12 months we had it revalued to $22 million. And last year we bought an office asset in Gold Coast, and again, multi-assets, you get the smaller tenants that this work from home is not such a big impact. And that asset, the Gold Coast has been going through a very large population from the remnants of COVID. You've got Melbourne, Victoria and Queensland, large populations heading up to Queensland. And the Queensland and Gold Coast property and office market is experiencing very tight occupancy measures. They're down to about 6% vacancy in Gold Coast, and that asset's doing well, and we'll probably get that revalued shortly, and we expect to get a bit of an uplift on that. So look, where are we seeing value at the moment? We are looking at, the hospitality sector. So during COVID, again, it was an asset that a lot of these hotels and hospitality assets got hit hard through lockdowns. The owners at the time were really, their balance sheets were under pressure. So coming out of COVID, with the COVID restrictions being released, we saw a lot of uplift in activity. And we saw vendors then starting to wanting to sell their properties to repair their balance sheets. In the last 12 months, we have established a new syndicate. Typically, we go for a single asset syndicate. This particular one, we thought it'd be good to have a bit of diversity. Diversity both in terms of geographic location, but also operating model, because hospitality assets can either be leased or they can be operated under a hotel management agreement. We've got 2 assets to create, and we're looking to grow this portfolio. The initial portfolio comprises of a Seabull in Mandurah, which is a hotel that's operated under a hotel management agreement with the world's largest hotel operator, Accure. And the other asset was a Quest in Fremantle, in the portside city of Fremantle. What we've seen is domestic tourism being very strong with these 2 particular assets, and that's a bit of a focus for us. And as COVID restrictions are reduced, then we will see intrastate and international travel and tourism come, and that'll boost demand for these assets. But they're already very strong on a domestic demand basis, and that was one of the factors that influenced us on looking at these 2 assets. We bought them on a weighted average passing yield of 8.4%. But there's another metric we tend to look at, and that's on a dollar per room basis. We bought the Siebel in Mandurah for $137,000 a room, which, normal replacement cost is $300. So we think we picked that up very well. And the Quest in Fremantle we picked up for $300, and that's almost a brand new asset that was developed in 2016, and again at replacement cost. So we see really a tremendous rebound coming through, and we're seeing that through the stats that we're getting from the hotel that we own, where average daily room rates and occupancy are increasing. So this particular syndicate, we are paying out initially a 7.5% distribution yield. We'll pay that quarterly, but we'll grow that as income grows, and also as we acquire new assets, which will be accretive to earnings and accretive to the distribution yield as well.
Okay. So I guess we've seen some case studies, but how do you, one of the things that everybody looking at this is, how do you guys assess a deal? Like there might be at any one time 10 deals on the market, right? And how would you choose this particular property over something else? We talked about value, we talked about what you guys prefer to do, but would you pick one over the other?
Yeah, look, it's a good question. We look at probably 80 to 100 opportunities a year. We probably buy 2 or 3. And as I said, our focus is on value. We also, and which I also mentioned, we also look at the vendor because we look at off-market opportunities. And we get off-market opportunities mainly through our network with agents and vendors alike. But looking at, why we choose particular properties, we look at the value metrics tend to be similar across all sectors, which is, your passing yield. Again, we focus on properties that can deliver investors a 7 to 8% starting income yield, and we look to grow that over time. We look at, typically your capital value, which might be dollars, purchase price per room for the hospitality sector, or it might be purchase price per square metre of net lettable area for an office or a shopping centre, or it might be dollars per square metre of site value for industrial. It's very important that you assess your factors, which, if a tenant does leave, how can you make sure that is it an attractive property that you can release it at the current market value? And how long has this tenant been there? How long would you expect it to be staying there? Is there an opportunity to extend the lease? Is there additional value that we can extract out of the property through developing greater NLA, or assisting the tenant to expand, or just increasing rent? There's a variety of different ways, and different sectors produce different opportunities, but we always resort to looking for value. Value is assessed in different ways, but typically we try and, we don't care which sector it's in. We just make sure that we reduce our risk factors of tenancies, and we look to deliver a stable income yield to investors.
Yeah, okay. Now, if I get you to stop sharing screen.
Sure, sorry.
I forgot about that. Probably got a few more questions that our investors normally ask. Is that so? Take us through your vetting process. A lot of questions around that DD process. I think that comes up more and more as every deal that not only that we do, but our community keeps asking. Because in this market, it's sort of, how do you define a yield? It's almost everywhere. You've got people who are buying 4% at the last Burgess Rawson auction in Townsville, and then you've got people who are buying 3% in Melbourne. So it's like, well, what does that And obviously at a larger level, you get a higher yield. But sort of how do you guys do your DD? I mean, you don't have to go into detail. We know that it's a detailed process, but just so that the investors know that this is a thorough process. We don't just look at the lease and that's it.
Oh, absolutely. Look, we have our typical due diligence checklist, which requires engaging consultants for both environmental, structural. We get lawyers in to assess the leases and property title details. We get evaluation done. And if we see a demographic report required, we'll get a consultant to do that as well. So we're very extensive in terms of the due diligence we do, and we make that available to investors if they require it or would like to have a look at it. But at the end of the day, we focus, and I sorry to keep hounding it, but we focus on value. So that means that we look to deliver a steady income yield of, call it 7 to 8% initially to investors. So that means we're looking at properties that have a passing yield of, call it 8%. And how do you find properties that are delivering an 8% passing yield when, as you say, you might find there's lots of properties being sold at 4 and 5%? Well, you do that by looking at off-market opportunities. You look at the vendor, what's their motivation to sell? Are they private? Are they institutional? But also you tend to be able to deliver that sort of value, you tend to look at sectors that are slightly unloved at that time. And then, as an example, I did mention that we were looking at office assets during COVID. When there was great uncertainty around the office sector, we chose a subsector of the office market that that we thought was resilient and going to survive. So far we've been correct in our thinking. And given the uncertainty around the office market, that was reflected in values, and we were able to pick up 2 office assets close to 9% passing yield.
Fantastic. So how do people get in contact with you? Like, if they want to find out what projects you've got at the moment?
Yeah, sure.
What do you put?
Look, what we typically do is people can check our website, which is accuream.com.au. We've got our current opportunities on our website, but they can also just register with us, give us their email, and we can shoot out an email every time a new opportunity comes up. But I would be more than happy to have a conversation with them directly, talk about what they're after and what we've currently got, and why we like the investments that we've got, and especially the ones we've got on offer.
Yeah, there'll be links and information below in the description of this video, so you guys can click on that link and go straight there. Or alternatively, you can always email us, helen@unicorn.com.au. We will give you a direct referral. Either one of those is fine. I'm happy to chat to you guys. It's all about, and the reason we have this show is that it's all about unbiased opinion out there for you guys to have multiple avenues of investing in commercial property and to have that diversification. So on that note, thank you, Rob. Thank you for being here today and showing us the case studies, because it's always really good. And if you guys are interested, please, there's information below. Find out more. Do reach out to Rob and his team. Well, so thank you.
Thank you very much for the opportunity, and thank you to all the listeners. Thank you.